Imagine you're lending money to a friend who promises to pay you back with some extra cash as a thank you. This is essentially what happens when you buy a bond. But there's a lot more to it than just borrowing and lending. In this video, we'll break down the world of bond investing and compare it to stocks and cash, so you can make informed decisions about your money. Bonds are essentially debt securities issued by companies or governments to raise capital. When you buy a bond, you're essentially lending money to the issuer for a fixed period, usually 5 to 10 years. In return, they promise to pay you back the principal amount plus interest. The interest rate, also known as the coupon rate, is set when the bond is issued and remains constant throughout the bond's term. Let's take an example. Imagine you invest in a 5-year bond issued by a reputable company with a face value of $1,000 and a 4% annual coupon rate. The issuer promises to pay you $40 in interest each year, plus the principal amount of $1,000 at the end of the 5-year